Okay, so welcome to this YouTube channel. This is your friendly neighborhood bull, Adam Khoo. Well, at least that's what people call me. But it's really tough to be optimistic and bullish nowadays with all the very scary headlines. So the most recent headline that came out just today is that right now hedge funds are massively short the S&P 500 just before CPI, which is inflation data, and earnings are due to be released this week. So you can see that large speculators, mostly hedge funds, saw their net short positions in S&P E-mini futures increase to roughly 321,000 contracts. So first of all, if you don't know, what does short mean? Short means that you're betting against the market. If the market goes down, you make a lot of money. If the market goes up, you lose a lot of money. So hedge funds are mostly professional investors, and what this is saying is that most of them are very pessimistic about the market. They expect a big crash this week, so they are heavily short the market. Now, how short are they? Well, this chart says everything. So you can see that this shows you the amount of S&P E-mini futures contracts. They are either net long or net short. No, net long means they are bullish, they expect the market to go up. Net short means they are bearish, they expect the market to go down. So as of now, you can see they are net short about 321,000 contracts. So what does that mean? Well, roughly right now, one contract of the S&P E-mini futures is $250,000. So multiply by 321,000 contracts, that means hedge funds collectively are short the market by $65.9 billion. That's a lot of short, okay? And this is the biggest short position they have since 2011. That's like more than 12 years ago, okay? So you can see that right now they are massively short. Last time they were this short was back then in 2011. Now, there were also other times when, again, hedge funds, which are professional money managers, were very short the market. This was back in 2015. This was back in 2020. And this was also just a couple of months ago in December of 2022. So first of all, the question is that why are so many hedge funds short the market? Why are they betting on a big crash that's going to happen very, very soon? Well, first of all, there's a lot of economic reports coming up this week where they expect a lot of volatility. So you have got on Wednesday CPI data, which is inflation data. And then Thursday, you have got FOMC minutes by the Federal Reserve, and they got PPI data coming on Thursday. So if inflation data, CPI and PPI comes in higher than expected, yep, the market could crash. Definitely. So a lot of hedge funds are betting on, yeah, inflation's not over. It's like the monster. You kill the monster, you turn back, it comes back and kills you again. So they think that it's going to be really bad. And on Friday, core retail sales are coming up, and nowadays, if economic data is not as good as expected as what happened last week, markets will begin to sell off. So again, a lot of volatility coming this week, a lot of data coming up this week, and that's why hedge funds are kind of like, okay, let's go short, market crashes, we can make a lot of money. So the question is that, as a retail investor, should you follow their lead? Should you also short the market? Or even as a trader, should you short the market as well? Let's find out and let's think this through in this video. Now, of course, not only this, but the other big thing that's happening is earnings season. So earnings season is kicking off end of this week on Friday. And who's kicking off earnings season? JP Morgan, which is a bank. And as you guys know now, a lot of people are very pessimistic about banks because of the collapse of the three banks. Recently, a lot of banks have been tightening their lending, and so that leads to less loans and, of course, lower profits. And banks now, they are losing a lot of deposits. People are pulling out their deposits from banks, putting them into treasury bills, money market funds. So banks now are forced to raise their deposit rates to entice customers to stay with them. Now, what happens when banks increase their deposit rates? They pay more deposits to you for your savings, current account, and time deposits. That's not good for the banks because that increases the bank's cost of funds. So that lowers their net interest margin, that lowers their profit. So right now, a lot of people expect banks profits to really go down. And with JP Morgan reporting, oh my God, what if they report really bad profits? The market could really collapse. And so a lot of these hedge funds, professional money managers are thinking, okay, let's go short the market so we can make a lot of money if it collapses. So what do we expect from earnings season that's coming up again, end of this week? Does it look good? Not really, okay? It looks pretty bad. Let me show you some of the statistics. So the S&P 500 companies are expected to report year-on-year revenue growth of 1.8% for the first quarter 2023. So that's not very exciting, only 1.8% revenue growth. And this is the lowest revenue growth since quarter 3 2020. So you can see the one in kind of like this like off-white, right? That was the estimate in December, and the one in blue is the estimate today. So you can see that generally the estimates have been coming down. Analysts have been lowering their estimates, thinking that things are going to get worse and worse and worse and worse. So in a way, the bar has been set pretty low for companies to beat revenue and earnings because the expectations are really pretty low. Now, how about earnings? Are earnings looking good? Well, not really. Okay, you can see that earnings expectations have been cut over the last 6 months, but have in a way leveled off for 7 of 11 major sectors like technology, utilities, communications, industrials, basic materials, healthcare, and consumer staples. Only energy and financial earnings, their expectations are continuing to decline. Why? Very simple. You guys notice that oil prices have been collapsing. Well, of course, OPEC announced a cut in their supply, so oil did bounce up a bit. But I don't know if it's going to be sustainable, right? Because oil has been collapsing because of recessionary fears. When oil prices collapse, energy companies make less money. So that's why they cut the estimates for energy companies. And of course, like I said, the banks are in the shit house, so they've been cutting estimates for banks. So collectively, the S&P 500 is expected to report year-on-year earnings decline of 6.8% for quarter 1 of this year. So they're expecting collectively companies are going to have earnings contraction. That's not a good thing, right? And this will be the largest earnings decline since quarter 2 of 2020. Now, even more bad news. 79 out of the 500 S&P 500 companies have issued negative earnings per share guidance for quarter 1 of 2023, which is way above the 5-year average of 57 and above the 10-year average of 65. So we are above historical averages in terms of companies issuing negative earnings projections for the quarter. So with all these negative fundamental expectations, should you short the market as well? Well, you could if you think the market is going to go down, and there are many ways to short the market. You could always buy inverse ETFs, you could short the SPY, the SPX, you could short the S&P futures, you could buy put options. There are many ways to short the market. But be careful if you want to short the market, because remember that the market tends to go opposite of what everyone thinks. Again, if everyone is thinking the market is going down, it may go up, right? And people always, when they put on a trade, they always think that I'm going to be right. But what if you're wrong? So my point is, if you want to short the market, you got to be prepared to take a loss if the market goes up. And at the end of the day, it's nothing more than a coin flip. Seriously, right? Because we have no idea what earnings are going to be announced and how the market would react to it. And sometimes even if earnings come out bad, the bloody market could go up. All right? So personally, what am I doing? I'm actually not shorting the market. I'm not doing anything. I'm just holding on to the great companies in my portfolio, because even if it goes down temporarily, I mean, who cares, right? It's going to go up eventually anyway. And if there's any short-term weakness in price, I'm going to use that as an opportunity to add more shares. Wait, okay, let me clarify. Okay, I'm not going to short the market directly, but I do have kind of like some short positions on individual companies using bear call spread options and covered calls. And I'll talk more about that in a while. So in other words, for me, I don't need the market to crash to make money. Even if the market goes down a bit or go sideways, I'm going to make a lot of money with my bear call spreads and my covered call options, which I'll talk about in a while, right? But if the market goes up, then yeah, I could lose some money on those option trades, but I'll make even more on my stock position. So in other words, to me, I don't really care where the market goes, and that's how it should be as an investor. If the market goes down, that's good news because you get to buy more shares at a lower price. Some of your covered calls, bear call spreads will make some money. So you're happy if the market goes down, right? But if the market goes up, you're also happy because the stock positions you have are going to grow in value. So always remember that to be a successful investor, you must not care where the market's going. Whether it goes up or down, it's always good for you. All right. If you're like, the market must go down. If it doesn't go down, I'm dead. Or the market must go up. If it doesn't go up, I'm dead. That's not being a good investor. You have to be indifferent to where the market goes in the short term. But again, let me just say that if you intend to really short the market, be very careful. Why? Because at the end of the day, remember that right now the market is on an uptrend. You can see that clearly the market, the S&P 500, is above its 50 moving average. It's above its 20 exponential moving average. The 50 moving average is above the 150 moving average. Moving averages are sloping up. The market's above the 200 moving average. The 200 moving average is sloping up. The market's making higher lows and making higher highs, yet to be the next higher high. So probability based on technical market flow is that the market's going up, right? So if you short the market when it's on an uptrend, again, it's more risky because you're going against the momentum of the market. But some people are saying, but Adam, how the hell can the market go up if companies are going to report bad earnings? If earnings are going to contract, market goes up, how could it be? Yes, it could be, because always remember the most important lesson, that the stock market doesn't care where the economy is today. The stock market cares where the economy will be in 6 to 9 months. The stock market doesn't care what profits the company reports today. It cares what profits the company will report in 6 to 9 months, because the market is a leading indicator of the economy and of fundamentals, not the other way around. And the market tends to already price in and discount all future information. All right. So again, here are 3 charts to show you that the market can go up while earnings suck. So if you take a look at the top 10 strongest bull markets that started from bear market lows, you can see that again, the 4 strongest bull markets occurred during negative earnings growth. The 4 strongest bull markets occurred back in March 2020, where the market went up 75%. March 2009, market went up 69%. August 1982, market went up 58%, and 1970 market went up 44%. In all those scenarios, the earnings of the companies were contracting, right? You can see that the earnings growth was minus 15%, minus 7%, minus 16%, and minus 1.7%. And if you take a look at all the bull markets, the majority of them, out of 10 of them, 1, 2, 3, 4, 5, 6, 7 out of 10 of them happened during earnings contraction, which is what we're going through now. And only 3 bull markets started when earnings were growing. Yeah, so it could happen, right? I'm not saying that the market will definitely go up. I'm not saying that. But I'm saying that the market will not definitely go down just because earnings are contracting. Here's another chart. Going back all the way to 1970, you can see that again, annual S&P 500 earnings growth versus the stock market returns are not correlated, right? You can see that out of all the times when the S&P had positive returns over here, 2020, 1982, 1991, 1958, 1951, 85, 1970, okay, that was break even, right? 2015, okay, that was only 1%. And 1975, all right, a majority of them, earnings growth was negative. So don't ever think that the market has to go down because earnings are contracting. It doesn't have to. In fact, most of the time it's opposite. Market goes up when earnings suck. So why is this so? Because I've shown you this chart before. Remember that, again, equity, stock market prices typically or trough, however you pronounce it, right? Which means they bottom, okay? So stock markets typically bottom 6 to 9 months before company earnings actually bottom themselves. So again, you can see this blue line is the stock market price, and the market bottoms here, which again, I believe the market bottom, the bear market bottom was October last year, right? I believe that this bull market started after the bottom last year. Again, I could be wrong, but that's my theory, right? And again, we are now going up. We are now somewhere here. So as we are somewhere here, guess what? Earnings are still going down. And by the time earnings start to grow and you want to get into the market would already have gone up like over 100%. And that's why most people get in late, because by the time the fundamentals look good, the market's already very expensive. So the time you want to get into the market, which is around here, is when the fundamentals are still sucking. Now, some people ask me, but Adam, these are hedge funds. These are the smartest guys in finance. They have got millions of dollars worth of research. They have got their CFAs. They've got their years of experience. Who are we to be smarter than them? Aren't they the smart money? Not really, okay? One of the biggest misconceptions is that fund managers and hedge fund managers are smarter than you. They are the smart money. Nothing could be further from the truth. I can tell you that most of the time, many of these hedge fund managers are bloody idiots. They are not the smart money. They are sometimes even dumber than a lot of retail investors. Now, again, I'm not just saying this from my own opinions. Let's look at the facts. When were the last times these professionals were so short the market? Well, this happened back in December of 2022 over here. There's the arrow over there. This happened in 2020, this happened in 2015, and this happened in 2011. These were the times when these hedge funds were betting against the market crash. Now, what actually happened to the market? Let's take a look. So this coincides with this. So over here, you can see they were massively short the market. Did the market go down? No, the market went up and they lost, billions of dollars, right? Then it happened again over here. They went short the market. This was back in towards the third quarter of 2015. Now, this is interesting. You can see that when they shorted the market over there, initially the market went up, so they got screwed, they lost money. Then the market really plunged, right? It made what we call a double bottom, and the market took off. So the problem when you short the market is, even if you're right, even if the market goes down, you could be right too early, or you may get out too late. Like, for a fact, I know there were a lot of professional fund managers, right? They shorted the market here. They say, okay, we're going to short the market. When they shorted the market went up, they got fucked. Right? Oh my God, they're losing a lot of money, right? And what happened was that they closed their short position, they covered their shorts, they took a loss, and once they took a loss, the market went down. Market went down! But you're too late, right? And then some traders I knew, I remember that time, when it went down, they shorted the market again here, and it went up. Okay. But then I know people who shorted the market here, and when the market went down, they didn't take profits. They thought it's going to go lower, but sure enough, the market went up and their profits disappeared, right? And that's why it's really difficult to short the market, because even if you're right on the direction, you may get in too early and the market reverses to take you out. Or even if you're right, it goes down, but you don't take profits fast enough, it reverses up and your profits disappear. And so it's really, really hard to try and make money by shorting the market, because shorting the market is a very short-term trading technique. Whereas if you go long the market, it's very easy to make money because the market always goes up eventually. You just gotta be patient, right? And then again, they shorted the market here in 2020. What happened? This was the worst time to short the market. They shorted the market here when they thought the world was going to come to an end, and boom, they got screwed again, right? Excuse my language, right? Can't control myself sometimes. Okay, and then December 2022, they shorted the market again here, right? And market went up. Okay. So if you take a look at these again, professional hedge fund managers, they don't really have a very good track record for making money. Don't believe me? Let's look at this chart. Now over here, you can see that these are all the different hedge fund styles. Now, there are many types of hedge funds in the market. Now, you can see that when hedge funds, they go long and they go short the market, attempting to, pick a direction, for example. Or you look at CTAs, which are commodity trading advisors, which are basically futures traders who go long and short. You can see that, do they do well in the long run? No, right? Equity long and short hedge funds, over a 5-year period, they only make on average 2.45% return a year. On a 10-year period, they only make 4.8% a year. How about CTAs, which are futures traders? Well, over a 5-year period, they only make 0.44% a year. Over a 10-year period, they only make 0.26% a year. That freaking sucks. I mean, if you just buy the S&P 500 ETF and close your eyes through the ups and downs and not attempt to time the market, heck, if you just did that, you get 8.49% a year over a 5-year period and 13% a year over a 10-year period. And that's the thing. That's why I keep telling people that if you really want to make money in the markets, the simplest thing to do is to just buy the darn ETF and close your eyes and not read any kind of news or not attempt to get in and out of the markets. Now, of course, if you learn how to pick the top 1% of companies in the world, like what I do and I teach my students, then you can get a lot more than 8 to 13%. We're looking at 15, 20% returns a year, picking the best companies at discounts. And that's what we teach in our courses. Now, and as you guys know, I've always said that, never ever make investment decisions by reading macroeconomic data like GDP and interest rates and money supply. Doing all that is purely for entertainment. You should never use that to make investment decisions. And again, this is proof why. Hedge funds that trade based on macroeconomic data, they are called global macro funds. Have they done well over the long run? Again, look at the evidence. You can see that over a 5-year period, they only return 1.24%. Over a 10-year period, they only return 2.37%. Bridgewater, which is the world's biggest hedge fund that used to be run by Ray Dalio, he trailed the S&P 500 by almost 130% over the last 10 years. So time and time again, if you look at the evidence, the best way to make money is to either just buy an ETF and close your eyes through the ups and downs, ignore the news, ignore the macro data, or pick the top 1% of companies in the world, which is what I do, buy them at huge discounts, and that's how we beat the market many fold by staying invested. All right, now having said that, like I said, let me just show you my portfolio right now. Now, I did use some options recently. As you guys know, I am holding long-term investment positions, but I do have option positions as well. Like I've got a bear call spread on Viva, a bear call spread on Mercado Libre, Hershey's bear call spread, Google bear call spread. So what do these bear call spreads mean? So it basically means that I don't need the stocks to go down to make money. I just need them to not go up too much. So as long as they go sideways, they go up a bit or they go down, I'm making money on all of them, right? And I've got covered call options on many of these as well. So let me give you an example of, say, Viva, right? By the way, I'm holding Viva, the stock itself. I'm holding the stock, but I am simultaneously using a bear call spread strategy at a 195 strike price. So what does it mean? So this means that now my expiry date over here, and this is what we teach in our option courses, by the way. So do learn this if you want to learn to trade options like me, right? Okay. So you can see that like Viva, this expires on the 19th of May. I'm selling the 195 call, buying the 200 call, all right? So what the heck does this mean? So this means that from now to the 19th of May, right? It's about, about over 30 days, right? If Viva can stay below 195, I make all the profit, right? So in other words, you can see there's a resistance over here, right? So Viva could go down, it could go sideways, it could go up. I don't care where the hell it goes. As long as it doesn't go above 195, it stays below 195, I'm making a lot of profit. I'm making the maximum profit from my bear call spread. So again, that's the beauty of combining options with my stock positions, right? Because again, in the long run, Viva will always go up because it's a great company. But in the short term, I expect it to kind of like go sideways or go up a bit or go down, and I'm going to make a profit off that. Another example would be, for example, Mercado Libre. So again, if you take a look here, you can see Mercado Libre, it expires on the 5th of May. I'm selling the 1450 call, buying the 1460 call. So what does this mean again? This means that I'm holding this stock because in the long run, it will always go up because it's a great company. But in a short run, I'm actually having a short position at a strike price. What's my strike price again? I forgot, right? 1450, that's right, okay, 1450, which is somewhere, somewhere about here, okay? So again, Mercado Libre, for the next 30 days, right, or less, it can go up, it can go sideways, it can go down, it can go anywhere. I will make maximum profits on my option trades as long as it doesn't go above 1450 in the next couple of days, right? So I've got a pretty wide profit zone, and that's how I again combine options to generate additional income, together with my stock portfolio. And that's just a little sharing that I have. Again, if you want to learn how to trade options, how to buy the best companies in the world, do take our courses or do join the Ultimate Investors Playbook, where you get my live alerts, my live option alerts, my live stock investment alerts, as and when I invest and trade the market. So hope this has been useful. May the markets be with you, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.